Hey everyone, and welcome. Today we're diving into one of life's biggest financial adventures, getting your very first mortgage. I know, it can seem like a huge, intimidating thing, but we're going to treat it like a quest, breaking it down into simple, manageable steps. So let's jump right in. And let's not beat around the bush. This quote really hits the nail on the head. This is a massive commitment. But you know what? It's totally normal to feel a little bit daunted by it. The point isn't to be terrified, it's to be prepared. That's the million-dollar question, isn't it? Well, when it comes to this particular quest, the journey actually starts with you. It all begins by taking a really good, honest look at your own finances. Which brings us right to our first stage, a frank assessment of your own financial readiness. Because before you can convince a bank that you're a good bet, you've got to convince yourself first. You know, back in the day, lenders might have just taken your salary, multiplied it by 4, and called it a day. But not anymore. These days, it's a full-on deep dive into your finances. They want to see every penny coming in, every penny going out, and exactly what's left over at the end of the month. This affordability check, it's the new gold standard. And here's something that is so important to remember through this whole process. There's this huge pressure, right, to get on the housing ladder, but it's not a race. Your financial security is way more important. And this quote just says it all, doesn't it? It is so much better to wait until you're truly ready than to stretch yourself too thin and risk losing everything.
All right, let's talk about the first major hurdle you're going to face on this quest, saving up that all-important deposit.
Look, this is basically the #1 law of mortgages. It's not just about showing the bank you can save money. A bigger deposit makes you less of a risk to them. And in the world of finance, when you're less of a risk, you get a much better deal. Simple as that. You're going to see this acronym LTV everywhere. It sounds super technical, but I promise it's really simple. Let's say a house costs £100,000 and you've saved up a $20,000 deposit. That means you need to borrow £80,000. That's 80% of the property's value, right? So your LTV is 80%. All you need to remember is the lower that number is, the happier the lenders are going to be.
Okay, now this is where you can really see the price. Just look at the numbers. Look at the difference between having a 10% deposit and a 20% deposit. Wow. The interest rate is nearly cut in half, and your monthly payment drops by over 200 quid. Over just 2 years, that's £4,000 back in your pocket. Pushing just a little bit harder to get into that next LTV bracket can make a massive, massive difference.
Okay, so you're getting a handle on your finances. You're saving that deposit. The next part of our quest is all about, well, polishing your armor. It's about making yourself the most attractive candidate you can possibly be. I absolutely love this analogy. It just perfectly captures the right mindset. Lenders get to pick and choose from tons of applicants, and your job is to make sure you're the one that stands out for all the right reasons. You want to present the absolute best version of your financial self. So how do you do that? Well, here are 5 simple, totally doable tips you can start working on months ahead of time. First off, get on the electoral roll. Seriously, this is such a quick and easy win. Then, check your credit files. You'd be surprised how often there are mistakes that could get you an unfair rejection. And things like closing old credit cards and steering clear of payday loans, all these little things send a really strong signal to lenders that you're responsible, that you're a reliable person to lend money to. All right, you're financially ready, you've got a solid deposit, and your credit score's looking sharp. Now we get to the really big choice. What kind of mortgage do you actually go for? You know, with all the confusing jargon and thousands of deals out there, it really just boils down to one simple question you have to ask yourself. Do you want the peace of mind of knowing exactly what you'll pay each month? Or are you willing to take a bit of a gamble for the chance of your payments going down? And this slide lays it out perfectly. A fixed rate is like your insurance policy against interest rates going up. But a variable rate, well, that lets you ride the economic wave. Your payments could go down, which is great, but they could also go up, sometimes by a lot. There's absolutely no right or wrong answer here. It's all about choosing what's going to let you sleep at night. Now, if you do lean towards that flexible variable rate, it helps to know the different flavors. Tracker mortgages are pretty transparent. They just follow an external rate. But you've got to be really careful with the SVR, the standard variable rate. The lender can basically change that whenever they want, and it's often the really expensive rate they'll just dump you on when your good introductory deal ends. Now, speaking of flexibility, here's a question that could literally change your financial future. What if you could pay your mortgage off faster? Is it worth it to overpay? Seriously, just take a second to let this sink in. An extra £100 a month, that's it, can save you over £23,000 in interest.
And you'll be mortgage-free 4.5 years sooner. The impact of that is just staggering. It's honestly one of the most powerful financial moves you can make.
Okay, we are on the home stretch. You've prepared, you've chosen your mortgage type, and now it's time to secure the prize. But you've got to watch out for the final bosses in this game, the fees.
Okay, so this is super important. The interest rate you see advertised, that is not the whole story. A deal can look really cheap on the surface, but it might be loaded with fees that completely change how good it actually is. You have to look at the total cost.
I mean, look at this. An arrangement fee can easily hit £2,000. Just like that. Seeing that number on its own really drives home how much these extra costs can be. That's a massive chunk of cash you need to find from somewhere.
And it doesn't stop there. You've got the valuation fee, which is for the lender's peace of mind, not yours. Then there are your own legal fees. And then, oh yeah, the potentially big one, stamp duty. All of these have to be factored into your budget right from the start.
So, you've done it. You navigated the maze, you paid all the fees, you got the keys. Huge congratulations. But is the quest really over?
And this, right here, is maybe the most vital takeaway of all. Your quest doesn't actually end the day you get the keys. When your initial fixed or tracker deal runs out, do not just slip onto the lender's expensive standard rate. The really savvy homeowner is always ready to start a new, smaller quest, finding the next great deal. That right there is how you truly win the mortgage game.